Hello, Broker Nation. Just want to share a video here, a video interview today. One of the obviously most overwhelming subjects that everybody's talking about is what's going on in the market. I thought it would be valuable to share an interview with Rob Pieklo. Rob is a former manager or head of capital markets and operations at multiple large lenders like AFR and Ditech. He's in the process of starting his own mortgage brokerage. He's somebody that I talk to a lot about what's going on in the market and rely on for, to kind of translate what we're seeing and what he's seeing back to the broker community. So I asked him to spend some time with us today to dig in a little bit and get a better understanding of why we're not seeing the traditional improvements in rates and pricing that we would normally see with these kind of declines in the treasuries and mortgage-backed securities. So Rob, thanks for taking the time to spend some time with me and hopefully provide some very high value content for the broker community.
Thank you. Thanks, Anthony. Thanks for having me. And obviously this community is so awesome. Thanks for having me on. Hopefully I can provide some value to some folks out there, or maybe confuse a bunch of folks if possible. But thanks for having me. And I've used the community so much. It's been so helpful for starting my brokerage and kind of going through some been waiting patiently and sitting on the sidelines here. But you said something happened in the market. I'm not aware of anything. Is something going on?
Yeah.
It's so quiet and dull today, right?
Apparently something's going on. So what we talked about earlier, and one of the things that I'm really looking to share with brokers is, what are the factors that actually determine the pricing that we see? I think most people believe it's just simply, hey, here's what the MBS price is telling us, or here's where 10-year treasuries are, and that determines where pricing is. Not only do mortgage brokers want to know, or loan officers want to know what's going on with pricing, but they also have to explain it to their customers. So, you shared with me that there's 4 factors that really determine what the pricing is we see from our lenders. And I'd love to, kind of have you share that with the community and give some visibility into how important those things are to the daily price.
Sure. I guess we'll start off by saying how difficult a time it is, even though rates are going down, for the secondary marketing desks of our lending partners and just lenders across the country. Anytime there's volatility, especially when rates and pricing is moving at the velocity it is right now, it's an absolute nightmare for those that are trying to hedge and cover positions based on all the volume that's coming in. So this isn't good for anybody, whether it goes up or down, but going down specifically. We'll get into those factors in a little bit, I'm sure. So, we talked about 4 components. We talked about pricing and kind of what makes up the pricing of a loan. And we'll start off with there's the underlying security of the loan. It's the mortgage-backed security in which these loans are going to be sent to and pooled into, and that has a baseline price. I'm not talking about LLPAs and other things. There's the investor that's purchasing that asset for an investment or a yield. Then you have your MSR price, which is a mortgage servicing price. That is a implied number based on how long somebody expects to collect the servicing fee, and that servicing fee is industry standards around 25 basis points, but that can move between 25 basis points all the way up to 75 basis points, depending on the type of asset that's created. And then you have to put some implied numbers into your pricing as well. And we talked about it a little bit this morning. There's a hedging cost, and there's cost to take out hedges, and that's going to be put into your pricing depending on the timing of the loan and how much volatility that there is, whether it's a 30-day lock or a 60-day lock. And then you're going to have your operational cost, and operational cost is, there's usually fees that try to cover most of the operational cost in a loan. But then you'll also have, any additional operational cost that it takes to get the loan securitized, or anything that's not going to cover in the fee is going to be passed through in pricing as well. And then, and obviously the kind of main thing you guys are seeing today is that you have these components that go into price, and that's not what you're seeing here. That's not the only thing being displayed. Then there's margin, right? The last item is going to be margin. And based on capacity, we've heard that a billion times, and based on kind of where everybody is in trying to price volatility, they're adding margin, and margin's the last line of defense for a lot of these lenders. So you're seeing that now.
Let's talk about, let's get into the weeds on a couple of those things real quick, because I think in your normal market, things like hedge cost is not like it's not necessarily something that has a huge impact on price on a daily basis, but I think it's becoming such a big deal because of how big the moves are in the market. So what you explained to me, and let me know if I'm explaining it correctly, but my understanding is when a lender, essentially books a price or a lock on a loan, they're creating a hedge, and the hedge is based upon that coupon, that interest rate that's tied to that package of loans. So let's just hypothetically say a couple weeks ago that rate was 3.75%. What happens is as rates decline, so for every 100 basis points in price that the market improves, the lender will receive a margin call from the broker dealer who provided that hedge. And essentially a lender for every, let's just call it $1 billion in loans that are part of a hedge will have to pay, what do we say, $10 million as a margin call for every $1 billion in servicing that receives 100 basis points or better improvement. So basically, a lender over the last 3 to 4 weeks could have seen multiple, margin calls on one grouping of loans that they locked in at a certain rate. Now, the worst case scenario for a lender in this situation is they have the hedge, they pay the margin call, and then those loans never actually close because hypothetically the loan officer or the broker takes those loans and moves them to another lender to get a better price or to get a better interest rate for the customer. In that situation, that margin call just becomes a cost. If the loans close, then they get that margin call money back, is my understanding. So, let's dive into that.
Yeah, so it's a pretty complicated market, and these lenders are carrying gigantic positions. So there were some rules that came out on for our broker dealers, and basically if you're a lender and you're taking in locks from another entity, whether it's your loan originators or wholesale market, whatever it might be, you're turning around and taking the opposite position on those loans. So that way, if rates move, you're covered, or there's a hedge on what you've just locked in. It'd be an incredible gamble had they not taken a hedge out on the lock, and they're riding the market, which one isn't allowable really from most lender standpoint, and it's monitored on a daily basis. So, for these guys, their locks are coming in, they're taking out a hedge, and how they take out a hedge is they're selling what they call an MBS or a TBA, a to be announced MBS to a broker dealer. And then you're right, you had it almost there. It was as the lock comes in, there's going to be a model that's applied to that lock. So depending on the broker or the lender, the originator, it's going to be dependent on the product type, the rate environment, how far it is, and how high of a rate it is or how low of a rate it is. There's other things that go into it, and there's going to be a pull-through factor put on that loan. Let's just say loans pull through. I'm sure you've heard your account executives talk about pull-through. Let's just say a pull-through is 65%. Hopefully it's more than that, but if it's 65% on a $100,000 loan, someone's going to turn around and put out a hedge for $65,000 to cover that amount. But as the loans move and as these things go in aggregate, they're not taking out loans or taking out hedges for individual loans, but as these huge moves happen on these huge pipelines, they're getting called for margin, which means that the loans are going up in value and the hedge is going down in value. And if the hedge goes down in value, the phone is ringing off the hook to send the funds in the amount, as you discussed. If it's 100 basis points on a $1 billion hedge, they're asking for $10 million at that moment in time. And granted, it's a short-term call, but cash is king, as I put in my post. Liquidity matters in the mortgage business, specifically coming towards a quarter end. And in this case, these calls are happening. You get them back or get the funds back as these loans close, and they should be at a higher price. But we all know what's happening to pipelines in terms of moving loans, and customers are calling and asking for renegotiation policies and asking other lenders to take an appraisal from a different lender. So that's happening right now, and those are just straight losses for these lenders.
So hypothetically, in a scenario where let's just say a lender, a couple weeks ago, obviously rates have moved pretty substantially here in the last 30 days. That would be an understatement. Lender locks in $1 billion in loans at 3.75. They have a hedge cost that, a margin call of $10 million over the next couple of weeks due to the fact that rates improve so much, probably actually more than $10 million. If it's for every 100 basis points, we might be talking $20 or $30 million based upon how much the market's moved. So they stroke that check for $20 to $30 million if that's the hedge cost. Let's say half of those loans don't close because, brokers move those loans to another lender. Is that just total cost? Like that's a sunk cost. There's no
welcome to the mortgage business.
Yeah.
Right?
so that's the thing that a lot of people don't know. I just found out, I'm just learning this myself. So I think as a broker and as a loan officer, you might be naive to the fact that, hey, I moved these loans and it's not just me. There's 40,000 LOs across the country. If hypothetically we lock loans with a lender and half of us move those loans to another lender, well, that lender is absorbing a cost that they'll never make good on. Obviously they'll originate new loans and hopefully that offsets it, but that's a pretty big cost that I would imagine is occurring at mortgage bankers across the country.
Yeah, it's the pipeline shuffle, right? It happens a lot, and it happens in every space in our industry, and it's the nightmare of a secondary desk, right? You've built out models, you've put in everything you can to guess and have an estimate of where these things are going to be, and you manage it by the minute. But when rates move again at this velocity, you have there's no way to plan for or hedge for a move like this. You can have, different types of hedges on, and you can have stuff against mortgages, against treasuries. But when things move at this velocity, it's just near impossible to manage it. And when these loans go elsewhere, the other half of the asset that is supposed to make up for this cash position that's going out and the negative position that you are on the hedge, if it goes away, where does the money come from? Right? You need those loans. And if you're making, and a good example of this would be, you have pull-through models set up at 65 or 70%, and all of a sudden 50% pull through. That's significant. It's a significant loss, not only on the hedge side, and a lot of people forget that in the world of mortgage banking and being a correspondent lender or a wholesale lender that's taking these loans in, they're booking all this revenue from a GAAP perspective at lock. So much has to be unwound from an accounting perspective, let alone the cash positions these guys are in and the margin calls and loans falling out. They've already said they're bringing in this revenue from the lock you gave them last week or last month. And now all of a sudden they have to say, oh, I'm not going to get that revenue, reverse that entry, that deal's gone. And then hopefully there's enough new locks to make up for the difference, because everything's basically run on the difference or the delta of the months as they go. But it's just something that a lot of people don't quite realize. They see rates going down, they think, oh, this is fantastic, it's a one-way street, and these guys they must be making so much money, but that's just not the case right now. Will they be in a better spot in 30 days or maybe 2 weeks, 2 months, who knows? But are they gonna be in a better spot because rates are lower? Yes, there'll be more margin, and more the loans come in, they'll make up for it. But right now it's about liquidity and making sure they have enough cash to kind of withstand all the negative elements of a rapid deterioration in kind of the market itself.
So let's talk about another short-term big negative that's out there that is part of the equation, which is MSR and the impact that's having on pricing. So I think one of the interesting things that a lot of people discount is what is the current market what's the current interest rate environment's impact on existing servicing portfolios, because that does play a factor in everything. So any loan that was funded in Q4 of 2019, for example, those loans were at the time funded at rates that are higher, and the value that was tied to those servicing of those loans at those times was based upon where rates were and the assumption that we weren't going to see this huge decline. Now, fast forward, rates are lower. Now, if rates are lower, what is the impact on MSR? MSR is the servicing of past loans that we close with wholesale lenders. So if you have a servicing book that's full of loans from Q4 of 2019, what does that look like right now? Is anybody willing to buy that? Are the lenders in a good position, bad position? Tell us a little bit about that.
Well, I mean, there's ways to hedge MSR. So I'm not going to say everybody's in a bad position, but let's just say I think the word of the quarter will be write down. There's going to be significant write downs on the balance sheets of mortgage bankers and banks across the country that own MSR assets. MSR, in a real kind of easy description of what it is you're just going to take there's a fee that every single month is kind of paid to the servicer, and that fee they put a multiple on, and that's what the value of this MSR is. What happens is they take a 25 basis points fee, we'll say, they multiply it, let's say, by 4 or 5 times, and then they put they might multiply it by more, and then they're going to put this implied delinquency rate on all of the loans that they have. They're going to put implied prepayment speeds on all of the loans that they have. Prepayment speeds obviously have changed significantly and will change significantly based on where rates are, but there was assumptions made when that MSR was given a value. Now we're talking about a lot of loans, right? So these guys have, it's not just fourth quarter, but we can use fourth quarter as an example. Everything that was originated in fourth quarter is actually in the money now that could benefit from a refinance. These guys have written that at a certain prepayment speed, and fourth quarter rates weren't that bad, right? Like rates were pretty good. So it was really hard to predict or model that the prepayment's going to shoot up like this, or prepayment speeds are going to be much higher than what they implied or what they modeled for. So you're going to see these large books get hit for MSR value that they have, and if they're hedging it, then they're going to get obviously a positive from the hedge that they have on the MSR. But the MSR values themselves in these books are going to go down.
So for example, for every, let's just say for every $1 billion in loans that a lender has servicing on from Q4 of 2019, the valuation that it had at the end of, let's just say at the beginning of January versus where it'll be going into the second quarter, my understanding is that value probably dropped by somewhere in the neighborhood of 25%. So for every $1 billion in servicing that a lender has, you're talking about essentially a $2.5 million write down that they are going to, essentially feel when that servicing book is reevaluated at the end of this quarter. Now, if you compound that by, let's say they have, $5 billion or $10 billion in servicing, across the whole, across all of their servicing, that's, $2.5 million loss times hypothetically $10 billion in servicing. Now we're talking about $25 million in cash write down that happens at the end of the quarter. So there's that negative. Then there's the other negative, which is because rates are lower, those loans are prepaying at a higher pace, which is obviously not going to be favorable to the lender who's when they booked that servicing was assuming that that those loans were not going to prepay this quickly. And then there's this last component of it, which is, essentially the lender's ability to book MSR or take on new servicing is based upon the value of, their servicing book. And if their servicing book value is declining, then the leverage that they can essentially take against their servicing book declines, which limits their ability to essentially take on more servicing.
Yeah, I think you have it right there. So an MSR isn't a cash position. So cash comes in on a monthly basis based on the payments, but the value of that MSR is actually it's a GAAP accounting value, and it has a value. And as cash comes in, that GAAP value goes down as cash comes in. But when cash is king, like we talked about, and a lot of people use their MSR books for operational lines, or they'll have a credit facility against those MSRs. So you're right. We just talked about the cash crunch you're going to see on the front end based on margin calls. And then you're going to have this kind of accounting loss based on the loans and additional fallout they're going to see in the MSR piece, where they normally would go potentially if they're not flush with cash. In our business, it's never easy to be flush with cash because so much is invested in something like an MSR. When they go to borrow, basically you're taking out a loan on your house, and the house is worth $100,000, and when by the end of the quarter it's worth $75,000, you can take less out, right? So that's the way it works. There's certain LTVs allowed based on the total value of that MSR. I would expect to see, a 20 to 30% decline based on what the speeds are, and that's not even really catching up to where MBS prices should be. And when they do catch up, when MBS prices do catch up, if it happens at month end, then they'll be shown through on most of these lenders or MSR holders first quarter. But what we'll see is this kind of big decline of 20, 30%, and MBS pricing getting better, and those lower coupons opening up. You can see even more in the second quarter if rates get to where they should be in terms of the correlation with the 10-year and lenders kind of releasing some of this margin.
So if we had to kind of sum up in a short summary to brokers and LOs in the market on the things that are impacting pricing right now that's unique to this current market, and hopefully over the next couple of weeks or couple of months we see this dynamic change. But basically, number one, we're seeing a substantial increase in margin calls as a result of hedge costs because of the fact that pricing is improving at such a fast pace that it's adversely impacting lenders that have pipelines that were originated a week ago, 2 weeks ago, 3 weeks ago, prior to these big declines in pricing or improvements in pricing. Number two, you are seeing servicing values decrease as rates improve because the servicing values are based upon loans at higher rates. If rates improve, the likelihood of those loans at higher rates refinancing or prepaying increase, which decreases the value of the servicing, which has a direct financial impact on the lenders that are holding those servicing because they have an immediate write down they have to take on a quarterly basis based upon the current market value of their servicing. And then as those loans prepay, there's great, basically greater ramifications. And then the last thing is realistically speaking, understanding how does operational cost play into this. And there's been a lot of discussion about, capacity issues with different lenders. Obviously, you and I both know there's no lender in the country, even the most aggressive growth-focused lender, that is going to have underwriting and operations at a level to be prepared for what's happening in the market. So if you want to provide some, understanding of like, what is this? How does that impact things?
Yeah, I mean, that's it. I mean, it's from I'm not envious of the folks that are sitting on the desk today. I'll say that. It is not a bad time to be on the sidelines kind of watching this. I know rates are low and there's lots of loans to be had, but this volatility is absolutely nuts. I don't know how these guys are managing. And I guess to the broker community is think about the calls that you're getting from your customers, from your realtor partners that are coming up and asking about rates and what's happening with rates and if they're moving down, and multiply that by like 10,000 that are out there for some of our lending partners. And we're asking for renegotiation requests. Think about moving a pipeline. If you're doing that, just think about what that does in kind of some of the examples that we've talked about. I think some of the things I put in some comments or a late night rant I did on the Brokers for Better page was be a good lending partner. It's a two-way street. I think if there's anything that's going to be occurring in the market and for yourself and your pipeline, if someone's walking and they're walking, or you have to flip something because of competitive issues, just make sure those locks get canceled and help them out. Every little bit helps, and these desks would certainly appreciate knowing, if a lock's going to expire and it's in some stage that has a heavy hedge on it. That's a lot of risk for these larger companies to take on, assuming it's going to close and it's not. Just let them know ahead of time. And the volatility is when I did this and when I worked and kind of managed this on a daily basis, I mean, the only line of defense right now is margin. It stinks. I'm with everybody. I'm looking at it going, wow, it's not fair to the consumers right now because of this. But there's no other line of defense. There's no way to hedge. There's no way to do it properly. So you just have to add margin and wait until the market stops moving in the amounts that it's moving. I mean, just today, from when the pre-markets opened, the 10-year Treasury went, from 70 something basis points down to 38 basis points on a yield perspective, and then back up to 59, and was sitting on 50 when we started our call here. That's a lot. That's more movement than we've had in the prior year happening in one day. So, this market itself is tough, and you can be good lending partners. And I mentioned it on the post as well, is, not everybody's gonna, be in a really good spot to help everybody out all the time when it comes to our lending partners. And sometimes loans have to walk. If you have to take loans elsewhere for the time being because of price issues or things you're dealing with, I know rates are low. I know you've said it a million times, Anthony. I know that the pricing shouldn't be a concern. But if someone calls you and says, hey, I got this rate from this guy, can you beat it? And you need to match it. You have to speak with your loans, and maybe that'll accelerate some of the changes or putting margin back in if possible. And what a great time to be a new entrant into the wholesale space, right? I mean, right now there's loans. If you have technology or have something that you can scale, I know staff is hard to come by, but if you have something that's scalable, this might be a great time to kind of get a partnership or get some more lenders into this AIM partnership and really try and gain share at the time when everybody else is really pushing a lot of margin in.
Yeah, so I think you're right, and that's one of the big things I've been telling everybody over the last week is, feel free to email partnerships@aimgroup.com. We have 16 lenders that are partners of AIM, and these are all lenders that are doing all of the pro broker or broker friendly things that we've been championing. But understand that you have to have multiple partners. You have to, be looking at, pricing. You have to be looking at turn times. We've made a big effort to bring visibility into turn times so everybody can understand that if things start to move quickly and you see lenders get to 15 days or 20 days in underwriting, you got to stay ahead of that, because the name of the game right now is going to be, fulfilling loans quickly. The longer loans in the pipeline and the longer, we have this volatility in the market and there's headlines like we're seeing, you're going to have customers constantly, inquiring about getting a better rate. And even though, rates should be improving, they're not necessarily improving. Then it becomes just, loans that are sitting there stagnant. So closing loans quickly, knowing your partners, knowing where they're at on turn times is important. But, just to wrap this up, guys, I think the big thing that we, want to make sure everybody has visibility into is, number one, locking loans with lenders just to do your own hedging is not a good practice. It's really, really important you understand what the costs are to these lenders. When you lock a loan, there is a insurance policy essentially being taken out against that lock by that lender. And when that loan doesn't close, they feel a very real cost. So if you're doing it, you have to imagine that there's hundreds or even thousands of other brokers across the country doing that. It's not doing what's right for your partner. So, just make sure you understand that's not the way to do business right now. We can't be negatively impacting our partners. Number two is understanding that, if you are going to move a loan, make sure you cancel the rate lock. Every little bit helps, from what Rob said. So canceling the rate lock allows that lender to know that they no longer have to have a position on that loan. They can absorb, they can, take their cost on whatever hedge they already had, but they at least, end the pain or end the, the cost that they have at that exact moment. Number three, understanding that the dynamic that's happening in the market is something that is a combination of things. It's not just MBS price and margin. It's a combination of MBS price, margin, hedge cost, and MSR values. All of these things impact the daily price that we're seeing from our lenders. The bigger a lender is an originator, meaning the more volume that they do on a monthly basis, the more impactful these moves are going to make on them. So, if a lender is doing a couple $100 million a month, these moves are going to be relatively impactful, but not at the same scale. If a lender is doing, $5, 10, $15 billion a month, that's where you're going to see a much different impact. So the goal of this is to bring some visibility to everybody, to share some market insight that's not just, your MBS highway or your market specific translation, but really connecting, our origination channel with the market and giving you guys an understanding of what's going on behind the scenes. Rob has been good enough to make himself available for a future Facebook Live that we're going to do in our Brokers Are Better Facebook group. So we'll announce a time and a date for that in the near future. But Rob, I want to thank you for taking the time and speaking with us today and sharing this with the broker community. Is there anything you want to share with them before we go?
Yeah, Anthony, thank you again. I think this is great. Hopefully, I provide a little insight. I will say that I see a lot of the comment and the sentiment. I want to make sure that we know that. I know we've said it a couple of times, right? But this isn't a money grab by our lending partners. This is literally a volatility hedge. Right now, we think things will somewhat normalize, but let's not think of it as a money grab. And they're going to really take advantage of this current market. It's not just capacity. There's a lot of things that go into this. So hopefully, everybody kind of gets that now. And again, a great time to kind of diversify our lending partners. If you're a broker, you have all your eggs in one basket. Sometimes it doesn't quite work out for our customers. So anybody has questions or anything, I look forward to the Facebook Live when we do that. Or if anybody wants to send me a message, I'm here waiting patiently for my licenses, like I always say. So I'll gladly answer everything I can.
Hopefully you get it soon, and we appreciate it, and we appreciate the commentary within the group as well. So thank you. Looking forward to having a future conversation. Hopefully the broker community, if you guys want to share your comments in the post when we share this, feel free to do that. I'm sure Rob will take a look at that and respond to any questions that come up. But thank you, Rob, and look forward to talking to you soon.
Thank you. Take care.